Here are my trading tips. I watch several time frames of the market I trade. I look at weekly, daily, 10-minute bars, even 1-minute bars. I exclusively trade S&P500 Emini Futures. Symbol is ES. That's all I trade. I don't feel good about any other markets. I've tried them all. S&P500 seems to fit my personality. I take both intraday trades and swing trades lasting anywhere between 1 and 5 days. So I do both. I use both limit and market orders. I use more limit orders on entries. Sometimes if I want to get out, I'll just get out on market. I mostly double in reverse. So if I'm short, I'm not just going to exit and sit on my hands. I'm going to go long. And then if I'm long and I have a profit, I short. I never scale in or out of positions. I think it's a losing strategy. I've tested it on many systems. It does not work in the long run. I always know my numbers: average trade, percentage winners, profit-loss ratio, etc. Always be aware of those numbers. If you don't or can't measure it, i.e. trading, how can you improve it? If you don't know your numbers, it's hard to improve it. You can watch your account grow, but in the long run, that doesn't tell you much. I trade on 10-minute bars. That's my favorite time frame. I never trust to look at candlesticks. I think they don't make a lot of sense, especially when you start changing around your time frame. Like if you're trading on 5 minutes, right, and you're seeing like a spinning top or a doji, right, or doji, whatever you call it. If you go down to 4 minutes, that same doji is now not a doji anymore. It's called something else, and it's not a pattern anymore. So that doesn't make a lot of sense to me. And if you have a trade station, you can test out these candlesticks ideas, and you'll find out that they don't work. I do not rely on gaps being closed. If it's a gap down, I usually buy it, but I don't sit and hope that it's going to close. Sometimes they run, and about half the time they run and they never close. They might close some other day, but you're going to get stopped out before that. I do not use any indicators. It's hard enough keeping track of what's going on your price graph, and then you're gonna also fill it up with lagging indicators. Doesn't make any sense. There's no predictive value in indicators, and if you've been watching price for long enough, you can know what those indicators look like without even looking at them. If I'm there, I use an end of bar stop. End of bar stop means most traders set their stops, let's say 10 points below their entry. So everybody sees them and you see them, whatever. So as soon as that stop is hit, you're out. What I do is, if I trade on 10-minute bar, I'm going to say, if my stop is hit, and that's going to be a mental stop, if my stop is hit, I'm going to get out at the end of that bar if that bar closes below or at my stop. You see what I mean? So if my stop is hit, but the bar is not closed yet, I still have 3 minutes before the bar closes, I'm going to sit on my hands. And I might lose more, but there's going to be times where market going to reverse and go all the way back up and give me a profitable trade. So not a lot of people do this, and it requires sitting there, or if you can code your strategy doing that. But it does save sometimes some trades. You can save money. If I'm not there, I'm just going to set a limit stop and walk away, or a market stop. I adjust my lot size with volatility and equity slope. So if the market is volatile, and you don't have to look at any indicators or anything like that, you can know if the market is volatile. If it moves 5 points in 5 minutes, that's volatile. And I also look at my equity slope. If my equity slope is sloping down or sideways, that's a sign of trouble, and I need to reduce my lot size and wait for better market conditions before I get back to my original lot size. I'm always aware that the market I trade, S&P 500, is not a trending market. The S&P 500, especially intraday, is not a trending market at all. Like Dow or Nasdaq, they tend to trend more than S&P 500, and you can see it just comparing several charts. I am a counter trend trader, although I do take trend trades, and when I'm right, the payout is huge. It's pretty hard to catch a nice trend on S&P 500 that lasts, anywhere between 5 and 10 days. But if you can do it, and if you're right, yeah, you can make a lot of money. But in S&P 500, for me, a lot of money is made in those little trades that go nowhere. I mean, in the market that goes nowhere, just trends up and down, trades up and down, up and down. Those are the best to make money. For me, at least. Here are my trading rules. Number 1, don't lose money. Everything comes out of this rule. Don't lose money. Use stops as much as I hate them. Set weekly goal, like points or profit, whatever your whatever market you trade. Always use patience. Be patient and practice patience outside of trading too. When you sit on that stoplight, put a smile on your face and have some patience with it. Accept a loss and move on. Yeah, that's a big one. Will you take the next trade after being stopped out 3, 4, 5 times? A lot of traders won't, you see, but usually those are the best trades to take when you just got stopped out a couple of times. So psychology is huge here. Stay in the game. If you're down and you quit, you'll never find out. Okay, so stay in the game, and staying in the game, the only way you're going to stay in the game is by following your rules, especially your system's rules. I would like to know, what are your trading rules? Please leave a comment below, and I would really like to know what your trading rules are, or just one top trading rule is fine. Thank you very much. I hope you enjoyed this video. Bye-bye.